Hello, my name is Vincent, and before I start going into the details, I want to strictly state that I did use AI to help me compile and organize this data, as well as confirm and check calculations for this project. I did validate all the information that was provided to me, and the financial sources we used are attached and included into the Excel file and have their own section. So first, I'm going to introduce Eastman and explain the choices of the comparative companies. For this analysis, I chose Eastman Chemical Company. They're a global specialty materials company headquartered in Kingsport, Tennessee. Eastman makes advanced materials, additives, chemical intermediates, and fibers used in transportation, packaging, construction, and consumer products. The reason I chose Eastman is because my earlier project examined its molecular recycling investment. This company also gives me a clear question for analysis that are those investments beginning to create value even while the broader company faces cyclical pressure? So for my guide sheet, I set it up as my firm and then the two comparative firms. I gave reasonings for why, and then I also set out my formulas. For the assignment, we had to detail whether they were operating, non-operating, or financing. So I also gave reasonings for those. Also, this company gives me a clear question for analysis and of how I can create value during these things. So now I'm going to explain the comparable firms. I selected Celanese and Huntsman as the comparable firms. Celanese overlaps with Eastman in engineering materials and capital intensive chemical manufacturing. Huntsman's another specialty chemical producer exposed to industrial demand and cyclical end markets. These aren't perfect matches, but in terms of what they produce and how they function, all depend on manufacturing assets, technical products, and they all have similar customers, so they provide a useful performance range when comparing their financial assets. Now I'm going to explain my data source and the trade-offs for it. So I listed my data sources, my 10Ks. I did the last 4 years for each company. I audited the SEC's form from the 10K data covering 2022 to 2025. The advantage of this data was that it was detailed, high quality information, and it also included affiliate investments, pension items, leases, and impairments. The trade-off for this data is it took more manual work because the firms use different account names and later filings can be retained from earlier periods. But I still decided that it was valuable because the details make my classifications of like the non-operating, operating, and financing easy to explain and to track. And then now I want to detail like how I used AI in this assignment. So for each company, I built a separate tab and gave details of why we factored things the way we did, and I wrote statements that correlated to those things. As like why we classified it this way. I also did a separate section for like the course calculations for each, like the notepad, the invested capital, free cash flow, and the formula that we used, and then an example of how it would be displayed in the Excel document. And I did this for all 3 businesses. And then AI actually helped me to write with the writing conventions. So the EBIT calculation was easy to check and validate that it was correct. I also added classifications for each of the financial aspects of the company. It helped me save time, but it was not automatic for like correcting signs and filling in missing data. And adding opening capital for the 2022 RIOC. And I had to manually review a lot of information in regards to the AI usage. Now I'm going to explain something that was a difficult classification for me. It was kind of how to treat investments in unconsolidated affiliates. I classified them as non-operating because they're related to affiliate earnings, but they appear below EBIT. Keeping the balance sheet treatment consistent with the income statement. In contrast to that, though, I did classify goodwill and intangibles as operating expenses or purchases because they represented acquisition capital committed to the operating the business or like help them out. If I excluded them, it would recalculate the return on the intangible capital and not on the total invested capital. But I also thought about adding an other account, but I feel like that wouldn't, it just like couldn't be separated out enough because it's like not detailed, or it can be like detailed as like non-operating. And so this is how my analysis was organized and computed. The workbook flows from the guide sheet to the 3 company tabs, and then a big summary tab for what went up and what went down within each company. On the companies tab, the blue values are filing inputs, and then the black cells are formulas that were used. And then the highlighted panel at the right shows all 4 of the calculated things for class. Let's see. So now I'm going to discuss the trends, the issues, and alternatives. Eastman's NOPAT was about $906 million in 2022. 1.029 billion in 2023, 1.10 billion in 2024, and 613 million in 2025. Invested capital stayed near 1.1 to 1.3 billion dollars. Free cash flow rose to about 1.126 billion in 2023, and then fell to 472 million in 2025. The ROIC followed the same patterns with 8.2%, 9.2%, 9.1, and 5.5. What honestly surprised me, though, was that the capital remained high while the operating profit fell, which explains the sharp ROIC decline. But even then, Eastman's 2025 ROIC remained above Celanese at a negative 3.8%. Let's see. Yeah, at a negative 3.8%. And then Huntsman was at a negative 2.3%. So overall, Eastman still outperformed them. These trends made sense given the weak manufacturing cycle and Eastman's continued investment needs, but they don't prove that molecular recycling has destroyed value within the company. Eastman reported that Kingsport's facility met its 2025 operating goals, produced more than 2.5 times its 2024 volume, and contributed about $60 million of earnings, improved versus 2024. Alternative explanations for company-wide decline included demand, product mixing, pricing, input costs, currency, and the normal ramp-up of a new plant. Also, when I was going through this, I defined free cash flow to measure as a proxy. Impairments or acquisitions can change the invested capital without representing ordinary cash flow within the company. So to close out my final thoughts, I think Eastman remains stronger for mostly everything than its competitors. But its 2025 decline was very significant. My conclusions are balanced by company-wide returns, while the recycling facility showed that it had operational progress. I think the real question, to be honest, with this financial data is that if that progress can raise NOPAT without requiring disproportionate new capital. And then my workbook guide solidifies my thoughts and ideas about these things, with conclusions through the financial data visible within my sources, classifications, formulas, and data checks. You can comparatively check each one of these against the other company and see where they differed. And then this has all the detailed operating breakdowns and non-operating and things like that of how I concluded these values. But thank you for your time, and I appreciate it.